Good morning. Commercial mortgage refinancing explained. So, commercial mortgage refinancing is one of the most powerful and misunderstood tools available to real estate investors and business owners. And when executed correctly, refinancing can improve cash flow, unlock equity, reduce risk, and reposition a property for long term success. And when done poorly, it can also erode value. And at Medallion Funds, we help clients refinance commercial properties with a strategy first approach and not just a rate quote. So, what is commercial mortgage refinancing? Commercial mortgage refinancing is just replacing an existing commercial loan with a new one, often with different terms, structure, or lender type. And unlike residential loans, commercial refinancing is driven by cash flow, asset performance, and market positioning, and not personal income alone. So, some common refinance objectives can include lowering your debt service, pulling cash out for reinvestment with the BRRRR strategy, or replacing short term or floating rate debt, or resetting your loan maturity if you're facing a balloon. And it could mean removing partners or restructuring ownership. And here are some key reasons investors refinance commercial property. Number one is to improve their cash flow. Refinancing into a longer amortization or a lower spread can significantly reduce payments, especially important in today's tighter operating margins. Number two is cash out refinance for growth. Many investors refinance to pull equity out and fund new acquisitions, capital improvements to the property, partner buyouts, or even a business debt consolidation. Number three is it reduces interest rate risk or risk. So it can move you from a floating rate to a fixed rate. It can move you from a bridge loan into a permanent debt loan. It could move you from a private loan into bank or agency financing. And these can materially reduce exposure to market volatility. Number four is to reposition the asset. So a stabilized or renovated property may now qualify for better loan terms than when it was originally originally financed. Commercial refinance loan options explained. Refinancing is not a one size fits all type deal. And here's some of your options that we can include. So we offer bank and credit union loans, who generally have a little lower rates and more conservative underwriting. And they look for stronger DSCR and balance sheets for those investors. There's also agency loans through Fannie Mae and Freddie Mac. And those are ideal for stabilized multifamily properties and can offer long term fixed rate with non recourse options. There's also CMBS loans, which can get you higher leverage and will often come with yield maintenance or defeasance requirements. So once you're in these loans, you're in these loans. It's useful for larger assets. And there's also debt funds and private capital. And these are great because their underwriting is a little more flexible and there's usually faster execution. But there are higher rates with fewer constraints, so it's a little more flexible. And really, the best refinance depends on the strategy and not the headlines. So let's look at what lenders evaluate in a commercial refinance. And some of the things lenders focus on are the debt service coverage ratio or DSCR, the net operating income or NOI, the loan to value or LTV, but also the property condition and the market surrounding it, the sponsorship experience, and their exit strategy. And this is why refinancing should be planned months in advance and not weeks. So let's take a look at some common commercial mortgage refinancing mistakes. So, number one is waiting until your loan maturity is already hit. Two is chasing rate instead of structure. Three is ignoring prepayment penalties. Four is overestimating appraised value. Five is underestimating lender reserves and escrows. And these mistakes cost investors time, leverage, and credibility. And now let's look at how Medallion Fund structures smarter refinances. So we approach refinancing as a capital advisory process and not a transaction. We analyze current and future cash flow, and we can stress test DSCR and rate scenarios. And that helps us match the loan to your hold strategy, but also to coordinate timing with market conditions. And our goal is not just an approval, it's long-term control and flexibility. So here are some final thoughts on commercial mortgage refinancing. And that refinancing is a strategic reset. And when done correctly, it strengthens your balance sheet and positions your portfolio for the next cycle. So if you're approaching maturity, facing higher payments, or sitting on untapped equity, now's the time to review your loan options. And that's what I'm here for. Please visit my website, buildraponline.com, to figure out how to get a hold of me. And I look forward to chatting further. Take care.